Imagine you are 20 years old standing at a crossroads. The world feels vast, and every decision seems to carry the weight of your entire future. You are looking at two paths regarding your housing situation. One path is renting an apartment. It feels like throwing money away into a black hole where you get no equity back. The other path is buying a house. It feels like building wealth, a solid foundation for your life. But here's the thing that most 20-year-olds miss. Neither path is automatically better for you. The right choice depends entirely on the specific market you live in and the hidden costs that are not immediately visible on a price tag. To understand this, you need to grasp a concept called opportunity cost. When you pay rent, that cash leaves your account and goes to a landlord. You do not own that asset. However, when you buy a home, you are locking a massive amount of capital into a single location. In a high inflation market, this becomes a critical calculation. If you buy a house, you are betting that the value of that property will outpace the interest rates you pay on the mortgage. If inflation is high, interest rates often rise to match it. This means your monthly mortgage payments can become significantly more expensive than you anticipated when you signed the papers. Consider the opportunity cost of that down payment. If you put $50,000 into a down payment, that money is gone from your liquid savings. If you had kept that money in a diversified investment portfolio, the power of compound interest could have grown it significantly over the next decade. In a high inflation environment, your purchasing power is constantly eroding. Holding cash is risky, but holding a single house is risky too, because you cannot sell a room to pay for groceries. You are forced to sell the whole asset. This lack of liquidity is the hidden cost of buying that young adults often underestimate. Now consider the hidden costs of owning a home. It is not just the mortgage payment. You have property taxes, homeowner's insurance, and maintenance. When a roof leaks or a furnace breaks, you are the one writing the check. There is no landlord to call. In a hyperlocal market, these costs can vary wildly. In some cities, property taxes are a massive burden that eats into your monthly budget. In others, maintenance costs are higher due to climate or age of the housing stock. If you are 20 years old, your career might not be stable yet. You might need to move for a job opportunity. Selling a house takes time and money in the form of real estate agent commissions. This friction can force you to take a job you do not want, just to stay in one place. This brings us to the foundation of all financial success, which is financial literacy. Research indicates that low financial literacy acts as a primary barrier to making sound investment decisions. Without understanding the math, you are susceptible to scams or poor choices. You might be told by a friend that you need to buy a house to be rich. But if you do not understand the difference between an asset and a liability, or how inflation affects debt, you could make a mistake that sets you back for years. Financial literacy is the prerequisite for navigating complex products. It is not enough to just have a smartphone or use a budgeting app. You need to understand the underlying principles of how money works. So, if renting is throwing money away and buying is a heavy burden, what is the solution? The most effective strategy for beginners involves low-cost, broad-market index funds and the power of compound interest over time. If you choose to rent, you should treat the money you would have spent on a down payment as an investment. You can put that capital into a retirement account like a Roth individual retirement account. This allows your money to grow tax-free over time. A Roth individual retirement account is a specific type of account where you pay taxes on the money now, but the growth is tax-free when you withdraw it in retirement. This is a powerful tool for a 20-year-old because you have time on your side. However, there is a critical distinction between general financial advice and personalized planning. While technology can explain concepts, it lacks the nuance to account for your specific risk tolerance and life circumstances. You must verify major decisions with human understanding or trusted, verified sources. A foundational step for financial health in your 20s is establishing an emergency fund and eliminating high-interest debt before aggressively pursuing high-risk investments. Do not try to time the market or pick individual stocks. That is a game for those with deep knowledge and experience. If you are carrying credit card debt, that is your enemy. The interest rates on that debt are often higher than any return you can get from investing. Paying off that debt is a guaranteed return on your money. Once you have a safety net of 3 to 6 months of living expenses and your high-interest debt is gone, you can start thinking about the housing decision again. If the math shows that the cost of renting is significantly lower than the cost of owning in your specific neighborhood, and you value flexibility, then renting is the smart financial move. You are buying optionality. You are keeping your cash liquid so you can seize opportunities as they arise. If the math shows that buying is cheaper and you plan to stay in that area for at least 5 to 7 years, then buying might be the right path, but you must be prepared for the maintenance and the lack of liquidity. You are trading flexibility for stability. There is no single right answer that works for every 20-year-old. The goal is not to follow the crowd or to listen to the latest trend. The goal is to understand your own financial landscape. Here is what you need to remember. Financial literacy is the foundation. Without it, you are flying blind. Whether you rent or buy, you must be intentional with your money. Use low-cost index funds to grow your wealth if you are not buying a home. Build an emergency fund to protect yourself from the unexpected. Eliminate high-interest debt to free up your cash flow. And always remember that technology is a tool, not a decision maker. You are the captain of your financial ship. You have to steer it based on the map of your own knowledge, not just the rumors of the wind. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.